The information provided by Crypto Daily Sun and this channel is for educational and informational purposes only. Crypto Daily Sun is not a licensed financial advisor or investment professional. The content presented does not constitute financial, investment, or legal advice. Before making any financial decisions, it is strongly recommended that you seek advice from a qualified financial advisor or investment professional who can provide personalized guidance based on your individual circumstances. Investing in cryptocurrencies and other financial instruments involves significant risk and may not be suitable for all investors. Past performance is not indicative of future results, and there is no guarantee that any investment strategy will achieve its objectives. Crypto Daily Sun and this channel are not responsible for any losses or damages arising from the use of this information or from any decisions made based on the content provided. Always conduct your own research and consider your financial situation, risk tolerance, and investment goals before making any investment decisions.
Welcome back. In today's video, we're diving into a critical aspect of cryptocurrency investing that often confuses both new and seasoned investors: the choice between long-term and short-term investment strategies. Understanding the differences between these approaches, their risks, and their rewards can significantly impact your success in the volatile world of crypto. So, let's explore these strategies in depth and discuss how to avoid common pitfalls, especially when emotions come into play. Determine your strategy. Long-term investment, also known as hodling in the crypto world. Long-term investing involves purchasing cryptocurrencies with the intention of holding them for an extended period, often years. The idea behind this strategy is to ride out the inevitable market fluctuations and capitalize on the potential for significant appreciation over time. Historically, long-term investors in major cryptocurrencies like Bitcoin and Ethereum have seen substantial returns. However, long-term investing requires patience and resilience. The crypto market is notoriously volatile, with prices capable of swinging dramatically in short periods. A successful long-term strategy involves selecting cryptocurrencies with strong fundamentals, solid use cases, and robust development teams. It's crucial to conduct thorough research and invest in assets that you believe will hold or increase in value over the years. Short-term trading. On the flip side, short-term trading focuses on capitalizing on short-term price movements. This could mean day trading, swing trading, or engaging in other forms of active trading. Short-term traders aim to profit from price fluctuations over days, weeks, or months. This approach requires constant market monitoring, quick decision-making, and a keen understanding of technical analysis. While short-term trading can potentially yield quick profits, it also comes with increased risk. The need for frequent trades and market timing means traders are more exposed to market noise and volatility. Short-term trading often demands a significant time commitment and a higher tolerance for risk. Avoid emotional trading. Emotional traps. One of the biggest pitfalls in both long-term and short-term investing is letting emotions dictate your trading decisions. Fear, greed, and FOMO, fear of missing out, can lead to irrational decisions, such as selling during a market dip out of fear or buying during a surge due to excitement. These emotional responses can undermine your strategy and result in poor financial outcomes. Stick to your strategy. Regardless of whether you choose a long-term or short-term approach, it's essential to stick to your predetermined strategy. Set clear goals and criteria for entering and exiting trades, and resist the urge to deviate based on emotional impulses. Creating a trading plan that outlines your strategy, risk tolerance, and investment goals can help maintain discipline and keep emotions in check. Make decisions based on research and analysis. The best way to avoid emotional trading is to base your decisions on research and analysis rather than gut feelings. For long-term investors, this means staying informed about the fundamentals of your chosen cryptocurrencies, such as their technological advancements and market position. For short-term traders, it involves analyzing charts, trends, and market signals to guide your trades. Develop a plan. Before engaging in any trading or investing, develop a comprehensive plan that includes your investment goals, risk management strategies, and criteria for making trades. Having a plan in place helps you stay focused and less susceptible to emotional decisions. Regularly review and adjust your plan based on market conditions and your personal financial situation. Learn from mistakes. Every investor will make mistakes along the way, whether it's due to emotional trading or other factors. The key is to learn from these mistakes and refine your approach. Keep a trading journal to document your decisions and outcomes, which can provide valuable insights for improving your strategy and avoiding similar pitfalls in the future. In summary, choosing between long-term and short-term investment strategies depends on your financial goals, risk tolerance, and the amount of time you can dedicate to managing your investments. Both approaches have their merits and challenges, but sticking to a well-researched strategy and avoiding emotional decision-making are crucial for success in the cryptocurrency market. By understanding your options and remaining disciplined, you can navigate the crypto space more effectively and work towards achieving your investment goals.
Thank you so much for watching. If you enjoyed this video, make sure to check out the rest of my channel for more great content. Don't forget to like, subscribe, and hit the bell icon so you never miss an update. Your support means the world to me. See you in the next video.